Every recession follows the same pattern. The signs are always there. The market gets overvalued. Credit gets too easy. Everyone thinks this time is different, and then it happens. The crash comes, and most people lose everything because they were not prepared. I have seen this cycle repeat itself over and over for more than 50 years. I predicted the dot-com collapse in 2000. I warned about the housing crisis in 2008. And right now, in 2026, I am seeing the same warning signs again. But here is what most people do not understand. A recession is not something to fear if you know how to position yourself correctly. In fact, the biggest fortunes in history were built during recessions by people who understood one simple principle. When everyone else is panicking and selling, that is when you prepare to buy. When everyone else is borrowing and spending, that is when you save and wait. The strategy I am about to share with you is not complicated. It does not require you to be rich. It does not require special knowledge or insider information. What it requires is discipline and the courage to do the opposite of what everyone around you is doing. Back in 1973, I made a mistake that cost me dearly. The market had been climbing for years. Everyone was making money. I got caught up in the excitement and I kept too much of my portfolio in stocks, even though every indicator was screaming that we were heading for trouble. When the crash came in 1974, I watched my account drop by 40%. It was painful, it was embarrassing, and it taught me the most valuable lesson of my career. The market does not care about your feelings. It does not care about your hopes or your plans. It follows mathematical patterns that have repeated themselves throughout history. And if you learn to recognize those patterns and act on them before everyone else does, you can protect yourself and profit while others are losing everything. If what I am saying resonates with you, hit that like button right now. Here is the reality we are facing in 2026. The stock market has been on an incredible run since the 2020 crisis. The S&P 500 has more than doubled. Real estate prices are at historic highs. Corporate debt is at levels we have not seen since right before 2008. Consumer debt is through the roof. Credit card balances are higher than ever. And yet, everyone is acting like the party will never end. They are buying homes they cannot afford. They are investing money they should be saving. They are taking on debt because interest rates are still relatively low, and they think they will always be able to refinance. This is exactly how it looked in 2007. This is exactly how it looked in 1999. And this is exactly how it looked in 1929. The pattern is always the same. Easy money leads to overconfidence. Overconfidence leads to bad decisions. Bad decisions lead to a crash. And when the crash comes, the people who are not prepared lose decades of progress in a matter of months. Now I want you to understand something important. I am not telling you this to scare you. I am telling you this because if you act now, before the recession hits, you can position yourself to not only survive, but to come out stronger than you have ever been. Most people wait until the crisis is already here, and then they panic. They sell at the bottom. They pull their money out of investments when everything is down. They make emotional decisions that lock in their losses. You're not going to do that because you're going to follow a plan that takes advantage of what I call the recession cycle. And the number one strategy that makes this plan work is building what I call a cash war chest. Let me ask you something honest. When you think about the economy right now, does it give you confidence or does it give you anxiety? If you are worried that a recession could wipe out your savings or your investments, comment below what scares you most about the next economic downturn and finish with this phrase, "But I will win this fight." Sometimes just admitting your fear is the first step toward beating it. Here is what a cash war chest is. It is not your emergency fund. Your emergency fund is there to cover unexpected expenses, job loss, medical bills, car repairs. You should have 3 to 6 months of living expenses in an emergency fund, and that money should be completely separate from what I am talking about now. Your cash war chest is offensive money. It is money you are setting aside specifically to deploy when the recession hits and everything goes on sale. Think about it this way. During a recession, quality stocks drop 30, 40, sometimes 50% from their peak. Real estate prices fall. Bonds get cheaper. Everything that was overpriced becomes reasonably priced or even underpriced. But here is the problem. If you do not have cash available when that happens, you cannot take advantage of it. You are sitting there watching the best buying opportunities in years, and you cannot do anything because all your money is either locked up in investments that are down, or you have already spent it, or you never saved it in the first place. The cash war chest solves that problem. It gives you the ammunition you need to strike when everyone else is too scared or too broke to act. So here is the plan. 7 specific steps you need to take right now before the recession hits. Each step has a clear timeline and specific actions. By the end of this plan, you are going to know exactly what to do in February, what to do in May, what to do in August, and where you need to be by December 2026. This is not theory. This is the same strategy I have used to navigate 3 major crashes and come out ahead every single time. Step 1. February through March 2026. Stop all non-essential investing and start accumulating cash. Right now, today, I want you to take a hard look at your current investment contributions. If you are maxing out your 401k, keep doing that because of the employer match and the tax benefits, but everything beyond that needs to stop temporarily. If you are putting extra money into a brokerage account, stop. If you are buying individual stocks, stop. If you are dollar cost averaging into index funds outside of your retirement accounts, stop. I know this goes against everything you have been taught. I know the conventional wisdom is to keep investing no matter what. But conventional wisdom does not account for what happens when you are sitting on the edge of a major market correction. From February through March, every dollar you were putting into investments needs to go into a high-yield savings account instead. Right now, in 2026, you can get around 4 to 5% on high-yield savings. That is not going to make you rich, but it is better than having that money sitting in a checking account earning nothing. And more importantly, it keeps that money liquid and available for when you need it. Let me give you specific numbers. If you were investing $500 a month outside of your 401k, that is $500 that now goes into savings. If you were putting $1,000 a month, that is $1,000 into savings. By the end of March, you should have at least $1,000 to $2,000 in your cash war chest, depending on your income level. This is not your emergency fund. This is separate. This is money you are setting aside specifically to invest when the market crashes. Step 2. April through May 2026. Cut your spending and accelerate cash accumulation. This is where discipline becomes critical. For the next 60 days, I want you to live like you are already in a recession. That means cutting everything that is not essential. Cancel the streaming services you are not actively using. Stop eating out. No new clothes, no unnecessary purchases. Every dollar you save during these 2 months goes into your cash war chest. Now I know what you are thinking. 2 months of sacrifice is not going to make that big of a difference. But watch what happens with the numbers. Let us say your household brings in $5,000 a month after taxes. Your essential expenses, rent or mortgage, utilities, groceries, insurance, gas, those probably run around $3,500 a month. That leaves $1,500 for discretionary spending. Most people spend all of that on entertainment, dining out, shopping, subscriptions, things they do not actually need. For the next 2 months, you are going to cut that discretionary spending in half. That gives you an extra $750 a month to add to your cash war chest. Combined with the $500 you were putting into investments, you are now saving $1,250 a month. By the end of May, your cash war chest should be sitting at around $4,000 to $5,000. That might not sound like a lot, but remember, we are not done yet. And when the crash comes, that $5,000 deployed correctly could turn into $10,000 or $15,000 within a couple of years as the market recovers. Step 3. June through July 2026. Reassess your current investments and reduce risk. Now that you have cash building up, it is time to look at what you already have invested and make sure you are not overexposed to risk. If you have investments in your taxable brokerage account, anything outside of your 401k or IRA, take a hard look at what you are holding. If you are heavily weighted in growth stocks, tech stocks, or speculative investments like crypto, you need to reduce that exposure. I am not saying sell everything, but if 70 or 80% of your portfolio is in high-risk assets, that is a recipe for disaster when the correction comes. Here is what I recommend. Aim for a 60-40 split in your taxable account. 60% in broad market index funds like the S&P 500 or total stock market funds. 40% in bonds or bond funds. Yes, bonds are boring. Yes, they do not have the same upside as stocks. But when the market crashes, bonds tend to hold their value or even go up. They give you stability, and they give you something to sell if you need to raise cash quickly without locking in huge losses on your stocks. Inside your 401k or IRA, you can be a little more aggressive because that money is long-term and you are not going to touch it for years or decades. But even there, if you are 100% in stocks, consider shifting 20 to 30% into bonds or a target date fund that automatically balances risk. During June and July, make these adjustments. Sell off the riskiest positions in your taxable account. Move that money into cash or short-term bonds. Add that cash to your war chest. By the end of July, you should have $7,000 to $9,000 in cash and a portfolio that is positioned to weather a significant downturn without getting destroyed. Step 4. August through September 2026. Build your target buy list and set your entry points. This is where the strategy starts to get exciting, because now you are not just saving defensively. You are preparing to go on offense. During August and September, your job is to identify exactly what you are going to buy when the market crashes and at what prices. Start by making a list of 10 to 15 high-quality companies or index funds that you want to own. These should be businesses with strong balance sheets, consistent earnings, and products or services that people need regardless of the economy. Think companies like Johnson & Johnson, Procter & Gamble, Costco, Visa, Microsoft. These are not the flashy, high-growth stocks. They are the boring, reliable companies that have survived multiple recessions and come back stronger every time. For each company on your list, look at the current stock price and then calculate what you consider a fair value. A simple way to do this is to look at the price-to-earnings ratio. If a stock normally trades at a PE of 20 and it is currently at a PE of 30, that tells you it is overvalued. You want to buy it when the PE comes back down to 20 or lower. Write down your target entry price for each stock. For example, let us say Microsoft is currently trading at $420 a share with a PE of 35. Historically, Microsoft has traded at a PE of around 25 to 28. So your target entry point might be around $300 to $320 a share. That would represent a 25 to 30% decline from current levels, which is exactly what you can expect during a recession. Do this for every stock on your list. Then do the same thing for index funds. If the S&P 500 is currently at 6,000, a 30% correction brings it down to 4,200. That is your buying zone. Write all of this down. Keep it somewhere you will see it. This is your playbook. When the market crashes and everyone is panicking, you are going to pull out this list and start executing. Step 5. October 2026. Maximize your cash position and prepare for deployment. By October, you should have been saving aggressively for 8 months. Your cash war chest should be sitting at $10,000 to $15,000 depending on your income and how disciplined you have been with cutting expenses. If you are not at that level, do not panic. Even $5,000 is enough to make a significant difference when deployed correctly. This month is about finalizing your preparation. Review your target buy list one more time. Make sure you have your brokerage account set up and ready to execute trades quickly. Confirm that your cash is in a place where you can access it immediately when you need it. High-yield savings accounts are good, but make sure there are no withdrawal limits or delays. Some people prefer to keep their war chest in a money market fund within their brokerage account. That works too. The key is liquidity. When the opportunity comes, you need to be able to move fast. Also in October, I want you to do something that might feel counterintuitive. Stop looking at your investment accounts every day. The market might still be going up. Your friends might still be bragging about their returns. Ignore it. You have already made your decision. You are playing a different game now. You are waiting for the sale. And the sale is coming. Subscribe to this channel if you want strategies based on 50 years of real market experience. No hype, just what works. Step 6. November 2026 through February 2027. Wait and watch for the catalyst. This is the hardest part of the entire strategy because you are not doing anything. You are just waiting. But waiting is an action. Waiting with cash while everyone else is fully invested takes discipline that most people do not have. During these months, the recession might start or it might not. The market might correct or it might keep climbing. You do not know the exact timing, and neither do I. What I do know is that the conditions are right for a significant downturn. Corporate earnings are going to disappoint. Interest rates are still elevated. Consumer spending is going to slow down. Unemployment is going to tick up. One of these factors, or a combination of them, is going to trigger the correction. Your job during this period is to stay disciplined. Do not get sucked back into the market just because it goes up another 5 or 10%. Do not panic and spend your war chest on something else. Keep saving. Keep adding to your cash position. By February 2027, you should have $15,000 to $20,000 in cash ready to deploy. When the market finally does correct, and it will, you're going to start buying in stages. Do not try to time the exact bottom. Nobody can do that. Instead, plan to deploy your cash in 3 or 4 tranches. If the market drops 20%, buy 25% of your target positions. If it drops 30%, buy another 25%. If it drops 40% or more, deploy the rest. This staged approach protects you from buying too early while also making sure you do not miss the opportunity entirely. Step 7. March 2027 and beyond. Execute your plan and hold for the recovery. When the recession hits and the market is down 30 or 40%, this is when you pull out your target buy list and start executing. Everyone around you is going to be terrified. The news is going to be filled with doom and gloom. Your co-workers are going to be talking about pulling their money out of the market. This is exactly when you do the opposite. You take that $15,000 or $20,000 you have been saving and you start buying the high-quality companies and index funds on your list at the prices you predetermined. Let me give you an example of what this looks like in practice. Let us say you have $18,000 in your war chest. The S&P 500 has dropped from 6,000 to 4,200. Microsoft has dropped from $420 to $310. Johnson & Johnson has dropped from $160 to $115. You deploy $6,000 into an S&P 500 index fund at $4,200. You deploy $4,000 into Microsoft at $310. You deploy $4,000 into Johnson & Johnson at $115. You deploy the remaining $4,000 split between 2 other companies on your target list. Now you wait. The market might keep going down for a few more months. That is okay. You still have money in your emergency fund. You still have your 401k continuing to contribute. You are not overextended. And then the recovery starts. It always does. The market has recovered from every single recession in history. Sometimes it takes 6 months. Sometimes it takes 2 years, but it always comes back. When the S&P 500 climbs back to 6,000, your $6,000 investment is now worth $8,600. When Microsoft climbs back to $420, your $4,000 investment is now worth $5,400. When Johnson & Johnson climbs back to $160, Your $4,000 investment is now worth $5,600. Your total $18,000 has turned into approximately $25,000. That is a 38% return, and you did not have to time the exact bottom. You did not have to get lucky. You just had to have cash available when everyone else did not, and the discipline to buy when everyone else was scared. If you know someone who needs to hear this strategy, share this video with them. The next recession is going to hurt a lot of people, but it does not have to hurt you. Now, let me tell you what is going to happen to most people. They are not going to follow this plan. They are going to keep investing right up until the crash happens. They are going to watch their accounts drop 30 or 40%. They are going to panic and sell at the bottom. And they are going to miss the recovery because they do not have any cash left to buy back in. I have watched this pattern repeat itself in 1974, in 2000, in 2008. And it is going to happen again in 2026 or 2027. The difference between you and them is that you now have a plan. You know what to do in February. You know what to do in May. You know what to do in October. You know how much to save and where to deploy it when the time comes. But here's what I need you to understand. This plan only works if you actually do it. Reading about it is not enough. Agreeing with it is not enough. You have to take action today, right now. Before you close this video, I want you to do 3 things. First, open a high-yield savings account if you do not already have one. Marcus, Ally, American Express, they all offer competitive rates. This takes 10 minutes. Second, calculate how much you can realistically save per month and set up an automatic transfer from your checking account to your new savings account. Make it automatic so you do not have to think about it. Third, write down your commitment. I am going to build a cash war chest of X dollars by October 2026. Put that number somewhere. You will see it every day. Your phone wallpaper, a note on your bathroom mirror, whatever it takes to keep you focused. The people who build wealth are not the ones who make the most money. They are the ones who have the discipline to save when everyone else is spending and the courage to invest when everyone else is scared. You have the knowledge now. You have the plan. All you need is the discipline to follow through. I have been doing this for over 50 years, and I can tell you with absolute certainty that the biggest opportunities come during the biggest crises. The question is, are you going to be ready when it happens? Drop a comment below telling me how much you are committing to save for your cash war chest by October. Subscribe so we can keep working on this together. And if this video helped you see the recession differently, hit that like button and share it with someone who needs it. I will see you in the next one.